Hi, I'm Steve LaFrance and welcome to our mid-year market update. The second quarter delivered a surprisingly strong rebound. The S&P gained roughly 15% and markets finished near record highs. What's notable isn't just the size of the move, but the backdrop. Markets looked through a Middle East conflict, an energy shock, higher inflation, and a Federal Reserve that has shifted from talking about rate cuts to possible rate hikes. Three forces drove this rally. First, the AI investment cycle moved from a headline story to a broad capital spending cycle. Chips, data centers, networking, and the power and cooling that support them. That CapEx is showing up in corporate results. Corporate America reported phenomenal first quarter earnings growth of 23.9% for S&P 500 constituents. Earnings momentum and raised estimates helped lift sentiment and justify higher valuations for many suppliers and infrastructure names. Second, participation broadened. The tech sector may have led, but small caps, mid caps, international, and emerging markets also posted strong returns. Small caps rose more than 20% in the quarter, and emerging markets have benefited from the exposure to the semiconductor and AI supply chain. Importantly, this rally isn't just a handful of mega caps. Analysts have raised 2026 S&P earnings estimates, and many non-mega names are expected to deliver meaningful growth. Want to know which stocks did not participate? The Mag 7. They underperformed just about everything and reminds us of the importance of diversification. Third, the energy shock began to unwind. Oil spiked earlier this year as the conflict disrupted supply, but by quarter end, prices had moved back toward pre-conflict levels. In fact, oil prices declined more than 30% from its peak. If lower oil persists, it could ease inflationary pressure by returning CPI from its recent 4.2% reading back to below 3%. This also gives the Fed more room to pivot later in the year, as the new chairman, Kevin Walsh, made it clear they are committed to the 2% inflation target and signaled little willingness to adjust policy based on oil prices alone. With recent payroll gains landing within positive market expectations, a stable unemployment rate of 4.3%, and a healthy wage growth of 3.6%, the consumer remains strong and should continue contributing to recent economic strength. In fact, many analysts have lowered their risk of a U.S. recession back to the long-term norm of about 15%. In short, the rally is supported by real earnings and broadening participation, and the unwinding of the energy shock helps the macro picture. But watch yields, inflation, and whether AI spending keeps converting into profits. As always, our team will continue to closely monitor incoming economic data and evolving market trends to help make sense of how the markets are performing. And again, thanks for your trust and confidence.